The European Union is a massive and pretty unique entity in the economic world. It's kind of like the federal government of the US, taking on the responsibility of policymaking. The Union is a group of member states that use the same currency, agree on policies and trade deals, and have shared departments, but still value their independence. It also has a combined output of nearly $20 trillion, second only to the USA. Despite not being a sovereign entity, it isn't afraid to exert its economic power. The EU, being a huge producer and consumer, wields a lot of power over countries within and outside its borders. This power poses a risk as it faces challenges both externally and internally. Economic growth for the largest and smallest member economies has been largely stagnant. So, is the EU actually good for the continent? Let's hit that like button for this video and subscribe to our channel for more amazing videos in the future. Welcome to Money-Minded World. Bringing together numerous independent states in the European Union, each with their own political, cultural, and economic backgrounds, was always going to be tough. The USA, which was somewhat comparable to the EU, took almost 200 years to come together, and its states didn't have their own vast economies to blend into the new system. Well, the reason for this is partly because the societies that existed in these regions before they were incorporated into states didn't have market economies like the West. To put it bluntly, the USA basically had to build everything from scratch, but that's not the case for the EU. The EU has vastly different economies within its member countries. Each country needs its own unique economic management style. This means that larger, wealthier, and more established countries like Germany, France, and Italy should have different economic policies than smaller, rapidly developing countries like Romania and Slovenia. While yes, the EU countries still have their own independence, when it comes to things like money and trade policies, the Union makes the decisions, and all countries need to follow them. There are no separate rules or policies for different kinds of economies. It's not always easy, because some countries are really good at selling stuff and others need help, so they have to find a middle ground. For example, Germany has really great industries and valuable products that they can leverage to get good trade deals. On the other hand, Romania, being a smaller and less developed country, might have a hard time competing in the global market for its exports. However, basic things like insulated wires and crops like wheat and corn are all pretty interchangeable. You can probably tell if a car or plane was made in Germany because it's high quality, but when it comes to copper wires and corn from Romania, they're just as good as any other country. And if there aren't good trade deals in place, people are just going to buy from wherever it's cheapest. Because of this, it's tough to come up with a trade deal that pleases all the EU countries and benefits the biggest economies the most because they all have different goals. The same goes for monetary policy. Each country has its own interest rates, but the European Central Bank sets the same rate for everyone in Europe. So why do the interest rates differ? Basically, each government has its own level of risk. Germany is less likely to fail to pay back loans compared to Greece, so Greece has to offer higher returns on bonds to get people to invest because they're viewed as riskier. Technically, the central bank has to consider all of this while also managing inflation, which is different across EU countries due to varying conditions, taxes, and cultures. However, the EU faces problems in this case as well. So basically, when a bunch of different countries use the same currency, making policies that work for everyone is tricky. This was an issue during the Greek financial crisis, which was made worse because the euro was worth a lot. Usually when a country is going through tough financial times, its currency loses value, making it cheaper to buy their stuff and helping them make money to pay off debt. But since all these countries have the same currency, that doesn't really happen as much. Now all economies go through the same thing. The EU isn't even the most extreme case where regional differences have to be taken into account for things like monetary policy and trade deals. In simpler terms, the gap in productivity between the best and worst performing states in the USA is similar to the gap between the most and least productive countries in the EU when we look at the output of each person. This is especially true if we exclude outliers like Luxembourg and Washington, D.C. Even though ECC isn't technically a state, it still functions as an economic entity that is comparable to many small economies in Europe. But putting small details aside, the poorest countries in the EU are on average getting closer to the richest countries when it comes to GDP per person. On the other hand, in the USA, the richest states are moving further ahead of the poorest states in terms of worker productivity. This is partly because these regions have fewer options for economic policy and more rules for how businesses can operate. However, they still have to follow decisions made at the national level. Even in countries with individual states, policies that benefit advanced industries and city centers may not benefit manufacturers in rural areas or farmers. However, even in large federal countries like the US, federal tax money can be used to support poorer regions through direct transfers or subsidies and contracts. These payments may not make perfect economic sense, but they happen anyway to prevent big gaps between cities and rural areas. Inflation also varies in different parts of the world, like major cities versus rural areas. However, the EU seems to have a unique problem because it uses one currency across multiple countries, but typically each country would just measure inflation for their whole economy. The EU uses the euro, which is shared by many countries with varying regional differences. Because of this, each country reports different inflation numbers that more accurately reflect reality. Meanwhile, other countries assume that all prices are going up at the same rate across the entire country. Although this seems like an advantage for the EU, having precise economic figures won't help if they can't take precise action to manage them. When you compare it to the US federal government, the EU has a small budget that mainly covers its administrative needs. Even if the EU had the power to use its budget to deal with issues like messed up trade deals and monetary policy, it couldn't make much of a difference. It's confusing how individual countries in the EU handle economic policies separately from the EU as a whole, which makes it hard to manage the economy during critical times like the debt crisis or Brexit. It's also a mess figuring out how to handle stuff like energy restrictions with Russia. This problem affects businesses in this area too. In theory, the EU's free trade policy should make it easier for businesses to operate and expand without worrying about borders. However, there have been significant challenges to this idea due to the additional regulations that businesses now have to follow in addition to their national ones. In terms of technology, regulations are taken seriously in the EU. International companies have had to make significant changes to abide by the regulations and continue to operate in one of the most profitable consumer markets worldwide. The regulations are mostly in favor of consumers and employees and reduce competition barriers, such as requiring smartphones to use the same charging ports. Although these laws may have benefits for the world overall, they make it difficult for EU businesses to compete on a global scale with companies that have fewer restrictions. This has caused the EU to fall behind the USA in terms of developing Asian economies and advancing in technology. As a result, it's missing out on a big opportunity to be a major player in one of the most profitable industries in the world. Tech companies from both the US and China are rocking it by spreading their impact and earning cash from a product that costs very little to make. To make more money, a German factory should sell more stuff by hiring more people, getting more materials, and maybe building more factories. When a tech company gets a new customer, it's usually easy to add them to an electronic system, so these businesses can grow really fast. Now, the EU does admit that it needs to improve in the tech industry and has put some of its budget towards creating another Spotify-like success story. However, there aren't many European tech companies that have made it big outside of the EU yet. It's worth noting that there are other barriers to tech development in Europe, such as the many languages spoken on the continent. This vastly limits Europe's options, as, unlike the continent, China and US companies can still build up huge domestic followings before taking on the global market. Not only that, the EU is experiencing a brain drain and lower investment because skilled developers and daring investors in Europe can make more money in the US market, which is more popular. And that's also thanks to the EU, which made it easier to work and invest across borders with its major world currency. All of these issues might make you think the EU was a bad idea, but maybe it just happened at the wrong time. But what do you think? Has the EU actually been good for Europe? Let us know in the comments below, and don't forget to subscribe. See you soon.